If you trade futures, forex, or crypto, and you feel like you're constantly one step behind the market, this video is for you. Most traders lose money not because their strategy is bad, because they fundamentally misunderstand how price is delivered. So welcome to the first episode of our foundation series, ICT Market Structure. Today we're going to dismantle the retail mindset and show you how the market really moves. So what is market structure? Forget everything you've heard about trend lines and moving averages. At its core, market structure is simply the sequence of price swings over time. It's the market's DNA. It shows us the directional intent, and most importantly, it reveals who is in control of price. And here's the most critical takeaway from this entire video. Before you even think about entries, indicators, or fancy setups, structure comes first. Get this right and you have a map. Get it wrong and you're just gambling. So the entire skeleton of the market is built from two simple things: swing highs and swing lows. That's it. A swing high is basically the peak, as shown here, and a swing low is the valley, as shown here. These are the turning points where price changes direction, even if it's just for a moment. On this chart, you can clearly see the peak here, that's our swing high, and down here, the valley, our swing low. These individual points are the alphabet of price. When we string them together, they form words, and those words create the market narrative. Now let's put those building blocks into motion. On the left, we have our bullish structure here. This is defined by a sequence of higher highs and higher lows. Price makes a new high, it then pulls back to a lower low, and then it continues its ascent. Now we can look at the left-hand side here. We have bearish structure. This is the exact opposite. A series of lower lows and lower highs. Price breaks down initially, it pulls back to the lower high, and then continues its descent, forming this pattern. The key is continuation. A market is considered bullish as long as it keeps creating this higher high and higher low sequence, and bearish as long as it creates this lower low and lower high sequence. This isn't a pattern, it's a statement of order flow. So the order flow here is showing bearish, order flow here is showing bullish. This brings us to the most important question a trader can ask. Who is in control? Market structure gives us the answer. If we see a clear bullish structure in this example here, it tells us the buyers are in control. They are willing to pay higher prices and defend pullbacks. And we can see in this example here, we're forming the higher highs and higher low sequence, showing a bullish order flow sequence. Now, crucially, this isn't just retail buying and selling. This structure is the footprint of institutional participation. Let's have a look at the bearish structure. This is the exact opposite, right? Bearish structure shows that sellers are in control. And again, it's printing this sequence of lower highs. Here we go. We can see a lower high. And then we're forming lower lows. And we're forming the sequence as a pattern. And this leads to a simple but powerful rule. If the structure is unclear, messy, or consolidating, your bias should be neutral. Don't force a trade where there is no clear control. Now, let's introduce a core ICT concept that separates institutional thinking from retail thinking: the dealing range. A dealing range is simply the range measured from a significant swing, so a swing low here, to a swing high. Why is this so important? Because it tells us where price is expensive or cheap within that specific leg of price action. This brings us to the key concept. Structure tells you the direction, like here, but the dealing range tells you the location. Retail traders only focus on direction. Institutional traders are obsessed with the location. They want to buy cheap and sell expensive. So in this case here, you want to be buying inside of a cheap range here in a bullish sequence, and then you want to be selling in a premium here at the high in a bearish sequence. So to reiterate, a dealing range is a measured high to low of a move. And in this case, you've got the low to the high, and it helps define where price is expensive or cheap. Let's break that dealing range down further. We take our range from the high to the low, so from here to the low, and we mark the 50% level. This is called the equilibrium. It's the fair value price. Everything above the 50% is considered premium. This is where price is expensive. And everything below the 50% level is discount. This is where price is cheap. This gives us the fundamental logic of institutional trading. In a bullish structure, you want to be a buyer, but you wait for price to pull back into a discount. So you would be buying in this range below the 50%. You buy cheap. In a bearish structure, you want to be a seller, but you wait for price to rally into a premium section, like shown here. The single concept will keep you out of so many bad trades. Stop chasing price, wait for the right location in the market. So let's just summarize this, because ICT logic tells us that you buy in the discount during bullish structure and you sell in premium during the bearish structure. So let's move on to a break of structure. So what happens when a trend is about to end? The first clue is a break of structure, or BOS. A break of structure occurs when price displaces through a key swing point that should have held if the trend were to continue. In a bullish trend, this means that the price breaks above the last higher high and continues forming these break of structures. So you see how we have a retrace, we break above that last higher high with an impulse. And the key word here is the displacement that's occurring here. So in this break above this higher high, you need to have a displacement that continues that trend. So whenever you have a pullback, you break past the higher high and you have a displacement in that direction. Not just a quick wick, it has to be a displacement candle. Now let's look at a bearish sequence. We have our lower low formed, a retrace, and then we break below that lower low, forming a break of structure. So if that trend were to continue going up, it would continue forming higher lows instead of lower lows. But in this case, we had displacement to the downside. We broke below that breaker structure, and then we continue retracing, break below the market structure, and we have our continued trend. So a market structure shift is the confirmation of a potential reversal. A market structure shift is a breaker structure that occurs after a significant liquidity draw. For example, price takes out an older high here, for example. Then we get that break in market structure below here. And this is our high probability signal where there is a market structure shift. It represents a true change in the market's narrative. But I cannot stress this enough, guys. A market structure shift is a context, not an entry signal. Just because you see a shift, it does not mean you should immediately hit the buy or sell button. It just tells you to change your bias and start looking for setups in a new direction. So let's put this all together. This is the logical sequence that ICT traders follow. First things first, we identify market structure. Are we bullish or bearish? Who is in control? Secondly, a liquidity draw is showing where is price trying to go. Is it reaching for an old high or is it reaching for an old low? Third step is displacement. We look for displacement. Do we see a breaker structure or a market structure shift that confirms the change in the order flow? And only then, number 4, we look for an execution using concepts like fair value gaps and order blocks, which we will cover in the later episodes. Structure alone won't make you profitable, but without it, nothing works. Before we wrap up, let's cover the mistakes that almost every new trader makes when learning structure. First, calling every single candle a structure shift. You need to look at the significant swings and not the noise. Second, using wicks instead of displacement. A wick is not a commitment, a body closure is. Third, ignoring higher time frame structure. The daily chart structure is far more important than looking at the 1-minute chart. And finally, trading structure without liquidity context. Structure tells you who is in control, but liquidity is the one that tells you where they are likely to go. You need to have both. What we've covered today is not only the first step, market structure is the foundation, but it's not the entire house. In our upcoming episodes, we build on the foundation by diving into liquidity and inducement, the fuel of the market, internal versus external structures, understanding the fractal nature of price, and finally, PD arrays and execution models, the specific entry patterns that we use to engage in the market. So make sure you subscribe You do not want to miss what's coming next. If you found value in this video, do me a favor, hit the like button, comment the words foundation below to let me know you're ready for the next episode. Thank you for watching, trade safe, and I will see you in the next one.